For the first time in years, the U.S. economy contracted by 0.3% in Q1 2025, while China's yuan surged, accounting for $725 billion in global trade settlements. This isn't just about the dollar losing ground. It's a deliberate shift in global trade, one that Washington is calling noise. But what happens when the world stops listening? Just days after President Trump's aggressive tariffs, China's yuan surged to represent 54.3% of cross-border settlements in March 2025, totaling a record $725 billion, according to China's State Administration of Foreign Exchange, SAFE. This marks a 12% increase in just 3 months. Meanwhile, the U.S. economy shrank by 0.3% in Q1 2025, its first contraction since 2022. The sharp drop was attributed to a rush of pre-tariff imports, overwhelming domestic capacity, according to the U.S. Commerce Department. This contraction raised alarms, highlighting the immediate economic consequences of the U.S. trade policies. The tariffs aimed at China instead seem to have triggered a global realignment away from the U.S. dollar. Analysts are concerned by what China plans to do next with its yuan-based settlements. On April 9, 2025, Reuters confirmed that China's central bank had issued guidance to major state-owned banks, halting proprietary purchases of U.S. dollars in a move to stabilize its currency. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way. This change comes at a time when China is flexing its economic muscle and positioning itself to reduce its reliance on the dollar in the wake of U.S. policies. China's share of dollar-based trade settlements has plummeted from 70% during Trump's first term to just 41.4% in March 2025. This decline is not just statistical, it's geopolitical. Chinese exporters now prefer to settle invoices in yuan, especially when trading with countries like Brazil, Russia, and Pakistan. Notably, Chinese energy companies have begun trading crude oil in yuan with Gulf producers, bypassing the SWIFT system entirely. This move marks a pivotal step toward a more yuan-centric global economy. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way. Meanwhile, between March and April 2025, foreign investors pulled $63 billion out of U.S. equities, with 72% of that liquidated by European institutions, according to the Securities Industry and Financial Markets Association, SIFMA. However, despite these outflows, the S&P 500 managed to finish April up 1.2%, thanks to strong domestic inflows. But the underlying concern is clear. Capital flight signals a growing reevaluation of U.S. market risks. J.P. Morgan's Marko Kanovich highlighted that these foreign exits are more than tactical. They reflect long-term hedging against dollar volatility and policy unpredictability. As foreign investors grow more cautious, U.S. markets are facing a shift in investor sentiment. Despite President Trump's claim that companies are moving into the U.S. in record numbers, the Wall Street Journal reports that many multinationals are pausing expansion plans until tariff clarity improves. Goldman Sachs estimates that reciprocal Chinese tariffs at 125% could reduce U.S. exports by $28 billion annually. The tariffs seem to be pricing out American firms while inviting others to take their place, especially as China strengthens its economic relationships with other nations. Trump defended the Q1 GDP miss by emphasizing a 22% increase in domestic investment. But analysts argue that much of this increase was linked to inventory stockpiling not new production. A DP reported just 62,000 new jobs in April, far below expectations, raising concerns of a labor market slowdown. This job creation miscasts doubt on the broader economic recovery, showing that the U.S. economy is struggling to maintain growth amidst these trade tensions. Inflation, which remains stubbornly high at 3.3%, continues to eat into purchasing power, and core PCE inflation is still well above the Fed's 2% target. The economy is teetering on the edge of stagflation, slowing demand, persistent inflation, and policy paralysis. Pantheon Macroeconomics warned that with inventories building up, job cuts may soon follow if the tariff situation remains unresolved. The looming possibility of stagflation adds an additional layer of uncertainty for consumers and businesses alike. Treasury Secretary Scott Bessent dismissed the Q1 downturn as market noise, but analysts are concerned that the economic fundamentals are much weaker than he suggests. Business equipment investment, for instance, grew at its slowest pace since mid-2023, and housing starts dropped 11% year-over-year. If tariffs persist, Bloomberg Economics predicts a possible contraction of 0.6% in Q2 2025. These signs of economic strain suggest that a deeper downturn may be looming. Drop your thoughts in the comments, and don't forget like and subscribe for the latest updates on global politics.